Good evening and welcome to our market review. Let us start with what happened on Wall Street this past Friday. The three major indices eked out small gains at the close, but beneath the surface tech stocks faced significant pressure. The Nasdaq finished at 25,297 points, posting a weekly loss of 2.78%. The S&P 500 closed at 7,354, down 1.49% for the week. Futures were flat after hours, suggesting cautious sentiment heading into the weekend with no clear direction. Stock-level divergence was stark. Tesla bucked the trend, rising 1.42%, but positions were heavily concentrated in a few heavyweight names. Nvidia fell 1.17% on Friday and plunged 7.89% for the week, making it the primary driver of tech weakness. The Bitcoin spot ETF also dropped 0.03% on the day and suffered a weekly decline of 7.95%, forming A with Nvidia and signaling a coordinated exit from AI and cryptocurrency-themed funds. In contrast, Cathie Wood's flagship ARKK fund rose 2.31%, indicating that capital may be rotating from mega-cap tech into small and mid-cap growth names. There were no verified unusual stock movements yesterday. No single stock saw an absolute daily change exceeding 8%. There were no new earnings reports or order announcements over the weekend, so the market's focus will be entirely on the weak structural setup formed last week. Now let us look at the global macro picture. The 10-year U.S. Treasury yield closed at 4.37%, edging slightly lower for the week. This decline in yields alongside the sharp drop in tech stocks is a telling divergence. It suggests money is rotating out of equities into fixed income as a safe haven rather than betting on rate cuts. The signal is clear: defensive positioning is strengthening, not liquidity easing. The VIX Fear Index closed at 18.41, still within the normal 15 to 25 range, but it briefly climbed above 20 during the week. The market is in a state of vigilance, not panic. There is no stampede, but the appetite for going long is thin. The dollar index DXY settled at 101.37, down a marginal 0.24% for the week, remaining broadly weak. A weaker dollar provides support for emerging markets and helps ease capital outflow pressure, but its direct boost to U.S. stocks is limited. In commodities, WTI crude oil closed at $69.23 per barrel, losing 3.15% for the week as demand concerns continue to weigh on prices. Spot gold closed at $4,096 per ounce, gaining 1.43% for the week and holding firmly above the $4,000 level. Gold's strength confirms that the market is pricing in a recession or stagflation narrative. In summary, global markets are in risk-off mode. The core driver is a valuation correction in AI leaders combined with simultaneous strength in gold and treasuries, forming a classic safe haven portfolio. The failure condition would be if the VIX falls below 16 on Monday and the 10-year yield reclaims 4.45%, signaling that selling pressure has lifted and we can turn neutral. Turning to the domestic environment, the yuan remains stable. Onshore USDCNY closed at 6.7897 and offshore at 6.8030, with an extremely narrow spread. The yuan appreciated slightly this week, and the weak dollar provides a stable policy window for the central bank. On U.S.-China relations, our verified web search found no new major developments in trade tariffs or technology controls between June 26 and 28. With no external event-driven factors, A-share sentiment will mainly be influenced by internal structures and the spillover from overseas markets. Our pre-market call for today's A-share open is flat to slightly lower. Overseas tech weakness will weigh on sentiment, but there were no new negative catalysts over the weekend and the stable yuan provides a buffer. The failure condition would be if northbound capital sees net outflows exceeding 2 billion yuan in the first 15 minutes, confirming accelerated foreign exit and shifting the call to a low open and low walk. For the A-share market today, we expect the Shanghai Composite to trade in a range, while the Chi-Next board will likely remain weak with greater downside pressure. Last Friday, the Shanghai Composite fell 2.26% to 4,027 points, and the Chi-Next board plunged 4.07% to 4,194 points. The risk of follow-through selling after the sharp tech drop remains. Nvidia and the Bitcoin ETF both fell nearly 8% last week, which will directly pressure sentiment in share-related sectors like optical modules, AI chips and servers. If the Shanghai Composite can reclaim 4,050 points with volume within the first 30 minutes, the call can shift to an intraday rebound. For sector focus, we continue to favor utilities and power as well as semiconductor equipment and materials. The power sector has repeatedly proven its defensive qualities. In a global risk-off and stagflation narrative, high cash flow, low correlation power stocks are the natural haven for capital. For semiconductor equipment and materials, the logic is not AI-driven but rather domestic substitution under escalating technology controls. The overseas AI chip route actually reinforces the urgency for China to break through bottlenecks. This sector showed relative strength last Friday and is expected to maintain structural outperformance today. On the risk side, be cautious with technology and thematic stocks, especially AI, semiconductor design and computer applications. The massive weekly losses in overseas leaders have directly lowered the valuation anchor for the entire AI space. The corresponding A-share sectors already fell sharply last Friday and face a double blow of further declines and negative sentiment today, so bottom fishing is not advisable. Northbound capital is also more likely to see net outflows today. Under the global risk-off backdrop, capital preferences are shifting from equities to safe havens, reducing the impetus for foreign inflows into emerging markets. Last Friday's sharp drop has been partially digested, but the lack of major positive catalysts over the weekend means foreign investors will likely wait for clearer signals. On individual stocks, there are no high-conviction new positions to open today. The market is in a correction phase, so the risk budget should be lowered to 0.45 with only small positions in high bottleneck names for observation. The data center transformer bottleneck and high-speed laser themes remain intact and are relatively defensive in a tech correction. Small positions can be held. For AI optics and wafer test equipment, the monthly trend is down but prices remain above the 200-day moving average. Hold existing positions but do not open new ones. Stocks with high geopolitical risk or elevated short interest should be exited. Our core judgment for today is that risk-off conditions continue. Focus on defense and hardware domestic substitution while avoiding AI software and high valuation themes. The probability call is 20% for an up day, 40% for a flat day and 40% for a down day. Thank you for watching, and we will see you next time.